Let's talk for a couple minutes about the stock market. What do you know about the stock market? Do you ever hear that the stock market's up or it's down? Usually hear about the Dow Jones Industrials. So let's spend a few minutes talking about these indexes. The indexes are the part of the stock market that give a sort of a barometer or take the temperature of the market at any given time of day. The market opens around 9:30 and it closes at 4 every day, except for holidays and weekends. So the Dow Jones Industrials is comprised of 100 stocks. It takes some special characteristics to belong to the Dow Industrials Index. Recently, a company was removed from it and another one added. It happens fairly regularly. Then there's the S&P 500, the Standard & Poor's 500, again, 500 stocks, and they cross industries, and they, again, also take the temperature of the stock market. And then there's the NASDAQ Composite Index. The NASDAQ is one of the actual trading areas of certain kinds of stocks, and that also is an index that tells us the temperature of stocks. So a lot of technology stocks that are traded on the NASDAQ, for instance. But it does have some other industrial type stocks and other areas, retail, etc. But it's very commonplace to find technology stocks. So there are different kinds of stocks. There are different ways. Let's just talk about investing in general. You can invest in stocks. You can invest in bonds. Bonds in particular are promise. Stocks are not. Stocks are kind of like Vegas. If you can't afford to lose any money, you shouldn't invest in the stock market. There are no guarantees. You can buy a stock for $1, tomorrow it could be worth 50 cents, or tomorrow it could be worth $2. If it's worth $2, you better sell it real quick because you've just doubled your money, and that doesn't happen very often. Obviously, there's not a lot of stocks that cost $1, but again, that's the idea that there's a bit of a gamble, if you will, in the stock market. Bonds, again, are based on a promise. You purchase a bond for a certain value, and you're told that at some future date, because of the interest rate that it pays, that you will have more money, that your bond will be worth more money, and it's a fixed price. So again, it is a significant promise. Right now, not only are there bonds, there are corporate bonds that are offered by companies to help finance their business, but also the U.S. Treasury sells bonds, so you can invest in the United States government. If I may say, in 2011, that sounds kind of like Vegas. What do you think? Whenever the bond rate goes up, whenever interest rates on bonds go up, then that's a better deal for the bond buyer. And if that happens, then typically the stock market goes down. So if bond rates are low, then it's a less attractive place to make money. So people will go to the stock market. So you can see that there are differences. People have different needs. Obviously, someone who has an amount of money that they can actually mix their portfolio or diversify your portfolio, they might be invested in both stocks and bonds. Another holding that one might have is cash. You always want something liquid, but of course stocks are fairly liquid because once you buy a stock, you can sell it the next day. You can sell it the same day, provided there's a buyer at the price that you want to sell it. So obviously there are some variety of ways that companies can raise money. That is the purpose of selling stocks and bonds. I mentioned that already in the discussion of bonds, but let's talk for a moment about stocks. When a company wants to raise capital, for the first time, it issues what's called an initial public offering. In other words, it offers people ownership. A stock is a piece of ownership in a company. And so this initial public offering is the first one. Initial means first. And so it means this is the first time the company has ever offered stock. And so once a company has started offering stock and they do this public offering, they make money off of the sale of those stocks, and that is a cash infusion into their business. Now, as the stock ticks up and down, it may go up to $5, it may go down to $2, whatever, the company doesn't make any more money at that point. It only makes money on the initial sale of the stock. And those of us who are out there buying stocks from other sellers, we may make money, we may make capital gains, but the company's not making any money off of the movement of its stock. But the value of a company is often based partially on its stock price. So it is in the company's best interest to maintain business practices that keep it profitable, obviously, and that make its stock price rise. This is something that companies often want, mostly because individuals within the company are invested in the company. They may own stock. So it's in their best interest to have the sale of the price of the stock go up so that if they choose to sell it, they will make money. So again, the stock market is a very interesting place to play around in, if you will. It is a risk, but you can make a lot of money. If you're not very comfortable choosing a particular stock and you don't want to go through the trouble of really researching different businesses, you could buy a mutual fund. You could invest in certain kinds of funds. There are even bond funds that engage in a variety of kinds of bonds. You might buy a fund of bonds, and inside there are municipal bonds, city bonds, corporate bonds. It could just be a big mix. So it's diversified and some of the risk is leveled out. Again, bond investing is a little safer. And so people have different goals in mind when it comes to increasing their personal wealth or saving for retirement. Each individual has to make a decision about how they want to invest their money. And so those would be things like stock, bonds, cash, real estate, you name it. It's really not very limited if you think about it, the different kinds of ways that you could invest your money.